Hello and welcome to ET Interview. It gives me great pleasure to bring on board Mr. Salil Parekh, CEO of Infosys, to talk about the way forward. The Indian IT sector post-COVID has got massively re-rated. But are there chinks in the armor given what is happening at the macro level, how attrition is moving higher, and more than demand, is there a blip, not a question mark, when it comes to the supply equation? What should investors look forward to for FY23 after a great FY22? If challenges, what are those challenges? So let's address some of those questions with the man himself. Mr. Parekh, a pleasure to have you back on ET Now. Thank you very much for accommodating this interview request.
No, thank you, Nikunj, and it's always a pleasure to be here with you on ET Now.
Mr. Parekh, for a sector where just about everything was going in the right direction post-COVID, now a little bit of fatigue factor has kicked in. Macro challenges are evident. Do you think the best of the COVID re-rating is behind us?
So, Nikunj, as you saw in the last quarter for Infosys, we had a good growth, 21%. Our digital business grew well, 37%. Even our core services grew in the quarter from the previous quarter. So all around the growth was strong. Based on that and our pipeline, we increased our growth guidance. So our growth guidance was increased to 14 to 16%. And we remain quite positive as we look ahead into what the demand environment looks like. Why that is, there are two types of demands that we are seeing. One is what we call growth-oriented programs, which are really big digital transformation programs with our clients, where they are building new digital, online, e-commerce capabilities to connect with their customers, to connect with their employees, to have more efficiency within their supply chain. And that's a huge growth area. And the second is there's a lot more focus on automation, on artificial intelligence, and helping to have more cost and efficiency direction. So those are the two themes that we are seeing very clearly from our client interactions, and that gave us confidence to increase the growth guidance for this year.
Some of your peers in middle of 2020 and early 2021 have said the following, that a multi-year cloud IT transformational cycle has started, and this just goes beyond the sugar rush, and this will be a multi-year double-digit growth cycle. Do you see that kind of invisibility? We may talk about this quarter and next quarter, but do you see the migration pretty much like Y2K, and this could be a multi-year trend?
So for us, you're absolutely right. The cloud is a big area of opportunity. One of the things we have done is put in place something we call Cobalt, which has a lot of cloud capability from Infosys readily available for our clients, whether it's on public cloud, private cloud, SaaS, or other areas. This part of the business is growing even faster. We discussed briefly, digital was growing at about 37%. Cloud, which is a part of our digital, is growing even faster than that number. And we see the demand for cloud today looking quite strong. In terms of what we look in terms of the growth, our focus is really more on what we give as a guidance for this financial year. And then overall, we shared at our analyst day a few months ago that the cloud capability, the cloud addressable market has a good long-term potential.
Sir, what is long-term potential in your mind? Every company has a different definition of long-term potential.
So the way we have seen the cloud growth, we gave examples that the size of that market itself is growing at between 12 and 15% over the next 4 or 5 years. The size of the cloud services market. And our capability is very good in that. And we believe we are gaining market share as we've done over the past 4 or 5 years. Given that, we felt over that time horizon, the cloud business had a good potential.
I have a lovely report from Kotak Securities in my hand. It is about BFSI comments from Goldman Sachs to Citibank. The outlook is pretty much mixed. While Citibank has indicated they're looking at increasing IT budgets, Goldman Sachs has a completely different view. Specifically, when it comes to the banking space and the North American banking space, are signals mixed? Are signals confusing, or they're clear?
So today we saw a good growth in Q1 on our banking and financial services business. We see a good pipeline where there are many large-scale digital change programs that clients are driving. We also see demand for automation and cost efficiency in banking. We did highlight what we discussed a few minutes before, some pockets of concern, specifically in the mortgages area. We are being watchful of what's going on, but today we see a good outlook overall as we look at banking and financial services, keeping in mind some of these pockets.
The news in Europe is becoming from bad to worse, and it could become terrible and horrible looking at the macro crisis. Are your models factoring in a slowdown coming from Europe and impact of that?
So there again, going back to our first quarter, our Europe growth was over 25% in that quarter. Our overall growth was 21%. So Europe was growing faster than the overall company. We have a good set of discussions in the demand pipeline today. We, of course, are very much watchful of what is going on with the situation on the ground in Europe. We see good demand, for example, with what is going on with our business in UK, in Switzerland, in Germany, in Denmark and the Nordic countries. And those are areas of good traction for us today. But having said that, we are watchful of what's going on, and we'll keep a lookout if things change on the ground.
Let me now address the biggest headwind, which is the attrition rate and salary hike. Now, in your comments, you have indicated that things will improve and attrition rates have bottomed out. But do you see that happening at a time when competitive intensity is so high?
So there we've seen, many of the initiatives that we've put in place over the last few months. In Q1, our attrition was lower on a quarterly basis than Q4. Our Q4 attrition was lower than the one for the previous Q3. And we see as we look today in Q2 and as we look ahead to Q3, attrition is coming more and more in control. The initiatives we put in place, much greater attention and focus on employee engagement, on career progression, on predictability of how things happen in terms of skilling and reskilling of employees, and compensation changes and increases. All of these things put together, we believe is helping us to bring attrition more and more in control. And over time, that will remain a positive factor as we bring it more in control. Having said that, we are in a position, last year we recruited 80,000 college graduates. In the first quarter, we had a net increase of over 20,000 employees, both college and lateral. So we are bringing in new employees. We are making sure our client engagement and the delivery of our work is at the highest level. All of those parameters are working well, and we believe attrition is coming under control.
The Infosys I've covered and tracked a couple of years ago had an attrition rate which was just above 10%. Now it's nearing 30%. When will it come back to the Infosys I've tracked in the past where we never worried about inflation, about attrition?
So there, one of the things we've seen is because of the strength of Infosys in its training, because of the strength of Infosys in all the new digital capabilities, we were seeing many companies, other companies who didn't have those sort of training, looking at Infosys employees. With many of the actions we've taken, we see attrition having come down in Q1 and in Q4, and we now see in attrition steadily coming under more and more control. My own sense is over the next few quarters, it will be in a better and better position.
One of the trend which is evident in the entire IT sector, and I think that is applicable for all the major IT companies, is that while attrition is high, there has been hardly any change in terms of salary and compensation for entry level joinees. That's an industry-wide phenomenon. Why is that? I mean, the companies are growing, sector is growing, but yet we've not seen a big change in the entry level hiring, at least when it comes to their salaries.
So there, as we look at the salary changes we've provided over the last 18 months or so, we've done salary changes 3 times in that period for our whole population. And we want to make sure that as employees join us, they have a very steady increase over the time period that they're working with us, and making sure that they're contributing to the work that they're doing for the clients and across different industries and service lines. So we've kept a clear focus on making sure that overall we've done multiple salary increases for the whole population, not just for any one level of the company.
So what does that mean for travel expenses, on-site business model, SG&A expenses? While incorporating the guidance for FY23, are you incorporating some kind of an inflation and uptick in SG&A and travel expenses?
So there, you're absolutely right. Our guidance in terms of margin considers that some of the travel expense will come back. Some of those expenses that were related to savings because people were working from home will start to come back.
Okay. The other interesting turn which the IT sector in a sense has now endorsed is subcontracting. Your numbers have increased. What does that mean? And given the attrition rate and how demand is so strong, will subcontracting continue to increase for Infosys?
Again, there we have seen that with the demand being so strong, last year we grew the business at about 20%. This first quarter, 21%. That's a very strong growth, a lot of market share that Infosys has been taking. We saw an increase in subcontractor usage. Maybe a year ago, we were something like 8% of our revenue. In the last quarter, we were something like 11% of our revenue. As we see that we are getting more and more employees joining in, over time, that's one area where we will see as a percentage that's starting to come down over the next few quarters. And that's something that will provide us a benefit within our operating margin.
Mr. Parekh, while I know that I will not get a numeric number from you in terms of a guidance beyond FY23, but if I connect the dots here, I'm simply connecting the dots here. You expect attrition to come down. You expect subcontracting rates impact to come down. You expect normalization to start happening. There are no headwinds. So can I safely say that FY24 will be a much better year than FY23? I know we are in the middle of 23. I'm preempting something 6 months forward, but I guess you would understand the spirit of my question. I'm putting the dots here.
So there, I am first focused on FY23, as you know and rightly pointed out. Our guidance relates to FY23. All of the parameters we have discussed, we've given you an idea of how those are progressing. Some of them, for example, travel will be increasing. Some of them, for example, subcontracting, attrition will be in a more controlled environment. So all of those will become plus and minus, and at the end of the year, we'll give a guidance for FY24. However, overall, from a technology perspective, I'm optimistic because the technology changes are massive, and our own foundation as one Infosys is very strong. So we remain positive about the future.
So my follow-up question, Mr. Parekh, is that why was the TCV deal, the numbers which you reported for the quarter gone by, was below 2 billion?
For the TCV, what we report is what we call large deal value. So large deal for us is anything about 50 million in size. This is not the entire TCV. And we have shared that in the past. Some quarters it is high, some quarters it's low. It's not large deals by design are not fully predictable. We did share that our pipeline, which was at the end of last quarter, beginning of this quarter, was in a very good position. And we looked out to see that there were several large deals in the pipeline as we looked ahead. So that number sometimes goes up and down, but the overall pipeline we were confident about.
I've had the pleasure of tracking Infosys, Mr. Parekh, for almost 20 years now. And there's one line which we've always used to define Infosys management commentary. Always undercommit and always over-deliver. Can I read in between lines here? Because you're sounding bullish, you're sounding optimist, you are confident about future, there is no slowdown. So are you being conservative? And are you likely to beat and surprise your shareholders and markets on all parameters?
So there, again, the Q1, as you saw, we increased our guidance. These are factors, which work on what we see happening in a quarter, what we see as the outlook, and then we make sure that all of those factors get converted into our guidance that we share. Our objective is to remain relevant for clients, be the best place for employees, and remain very much dedicated to making sure shareholders get the right benefits. So that will remain our commitment, and we believe we have a good foundation to keep doing that.
Infosys is growing because you're gaining market share or the pie itself is expanding?
So there, the view we have is we are gaining market share in an expanding pie. So if you look at tech services overall, the spend is going positive. But if you look at our growth compared to the industry average or some of the other peers, we are between 5 and 10 points faster growth over the last few years. That sort of increased or extra growth comes more from market share gain. This is primarily because you look at digital as one example. 4 or 5 years ago, we were at about 20 or 25%. This last quarter, we're at over 60% of our work is digital. Those areas are growing fast with clients because clients are adopting them. So the more we are aligned to that sort of a portfolio which is relevant for clients, the more we will see better growth.
So a couple of follow-up questions and a couple of last follow-up questions, Mr. Parekh. Digital accounts for, I'm going to take a leaf from your answer, over 60% of the total business. You are still getting 40% of the business approximately from the traditional business. But given that digital business is growing, the 60 could soon become 65 and 65 could soon become 70. When that migration happens, will that migration automatically start bumping up your margins because this is new business, this is high skill business, this is more relevant business, and this is more business which is customer centric?
So there, I think you're absolutely right. Our digital business, we have stated in the past, has a better margin profile than the core business, what we call our core business. So as we move more and more to digital, we have the opportunity to help on our margin.
So how do you see the next 3 years for Infosys and for the IT sector different from the last 3 years? In 2020, it was about survival. Now it is about realigning and controlling attrition rate. How do you see the next 3 years being different from the last 3 years?
So for the next 3 years for Infosys, really it's making sure that we are front and center of the cloud capability and agenda. That's where a lot of our clients are going. That's where they're building out new areas of growth. That's where the transformation is happening. And with our COBOL, we are really in a leading position there today, working with our clients. So that's going to be a big difference for us over 3 years. In addition to that, we have this concept which we call One Infosys, where all of our people, all of our capabilities, all of our services are working for the benefit of the client, especially on large, complex digital programs. And we want to make sure that we do more and more of that. And that's going to be a big driver for us as we look ahead. We hope to remain more relevant for our clients and continue gaining market share.
Mr. Parekh, you've been the architect for a lot of changes at Infosys, and soon you will be completing 5 years at Infosys. You've been reappointed in July 2022 till March 2027. So how will the coming 5 years be different for you from the existing 5 years? Let me redefine it. Salil Parekh 1.0 versus Salil Parekh 2.0.
There, I think we've had for the last 4 or 5 years a very strong growth and foundation built on what you have mentioned, more and more digital, more and more client relevance. Going forward, based on this extremely strong foundation and an Infosys which is well aligned to what clients are driving, we want to create a real leadership position in cloud, make sure that we are the leading company for digital, and continue to do things that are relevant for our clients, make sure that we build the best capabilities, the best solutions for our clients, and make sure that our employees feel completely engaged and well rewarded as we go through this journey.
And for the industry per se, Mr. Parekh, and I'm using again the COVID period as a reboot period from the Indian IT sector. Do you see that the Indian IT sector, even at this large base of $200 billion plus of exports, can easily grow in double digit? Of course, the growth rate will vary at different companies, but in general, do you see this kind of invisibility for the sector per se? Because whatever you will say, sir, now will be a benchmark for the sector per se.
So there, the sector, as you define, is very large. The whole industry, as you mentioned, over 200 billion. The opportunity is there because if you look at the global tech services business, we are still not at a major position as a sector, as an industry. We have a very good position, but the growth opportunities are quite enormous in front of us. So my expectation, my optimism is that the technology industry in India will continue to grow well.
Mr. Parekh, I must share with our viewers that I've been tracking Infosys for almost 22 years now. And there was days when we would always come to Infosys campus, enjoy the filter coffee, come to the pyramid and track your numbers. So now that things have normalized, I certainly hope that we get a chance to interact very soon over a cup of filter coffee and meeting you in person over and then discussing things.
No, absolutely. I look forward to that. So whenever you're ready to travel, please come here on campus. We have lots of filter coffee and we'd love to welcome you at the pyramid as well. Yeah.
Well, look forward to that, and thank you so very much for accommodating this interview request.
Thanks again for having me and best wishes.